You ever wonder how some companies just seem to stay on top for decades while others, they have their moment and then just fizzle out? Well, the secret isn't just about having a great product. It's about having a powerful, long-lasting defense. So let's dive into this idea of economic moats and figure out how the great companies really do stay great. But first, let's start with the flip side of that question. Why do great companies fall in the first place? I mean, we see it happen over and over again, right? Today's stock market darlings so often become tomorrow's cautionary tales. So what is going on there? Well, the answer is actually pretty simple and honestly kind of ruthless. Big profits act like a giant flashing sign for competitors. Just think about it for a second. When a company like Cisco was growing at an insane 40% a year, venture capitalists were literally throwing money at anyone who could compete with them. Or when a drug company like Pfizer is making billions from a new patent, you better believe generic drug makers have armies of lawyers trying to poke holes in it. It's a fact of business. Huge success always draws a crowd. So how in the world do you protect yourself from that inevitable onslaught? You have to build a defense. And in the world of business, the absolute best defense there is something we call an economic moat. So what is it exactly? Well, an economic moat is a durable, long-term competitive advantage that shields a company's profits from all those would-be invaders. And the analogy is just perfect. Think of a medieval castle. What protected it? A big, wide moat filled with water. An economic moat does the exact same thing for a company's financial fortress. Now, you can't talk about economic moats without talking about the legend who really made this idea famous, Warren Buffett. See, his whole strategy wasn't just about finding good businesses. It was about finding these wonderful economic castles that were protected by wide, sustainable moats. He knew that that was the real key to long-term investing success. Okay, that sounds fantastic in theory, but how does a company actually build one? Where do these moats come from? Well, it turns out there are 5 main blueprints, 5 primary sources for building one of these business fortresses. Let's break them down. First up, we've got a moat that comes from things you can't physically touch, but are incredibly valuable. We're talking about intangible assets. This can be a bunch of different things. It could be a super strong brand, like Coca-Cola or Apple, that makes people loyal no matter what. Or it could be a patent that gives a company like Pfizer a total monopoly on a drug for a number of years. It could even be a special license from the government that you need to operate, like for a casino, which just completely locks other people out. All of them are powerful, but a strong brand, well, that can often outlast a patent, which eventually expires. All right, moat number 2 is all about making it a huge, huge pain for your customers to leave you and go to a competitor. This is what we call high switching costs. And when we say cost, we're not always talking about money. A lot of the time, it's about the time, the effort, and the risk involved in changing. I mean, imagine your company has its entire workflow built around a specific piece of software. Ripping that out and starting over? That's a massive headache. Or think about a surgeon who has spent years perfecting a technique with an artificial hip from a company like Stryker. They're not just going to switch to another brand on a whim. The customer is, for all intents and purposes, locked in. Our third source, well, this one is a monster. It's arguably the most powerful moat in the modern economy, the king of the digital age, the network effect. The way this works is just beautiful. It creates this powerful, self-reinforcing cycle. A social media site like something from Meta is only valuable because all your friends are on it. An online marketplace like eBay is valuable because it has the most sellers, which of course attracts the most buyers, which then attracts even more sellers. It's this virtuous circle that creates a winner-take-all situation that is just incredibly difficult for a newcomer to break into. Fourth on our list is maybe the most classic business advantage of them all, just being able to do things cheaper than anybody else. Now, this cost advantage can come from a couple of different places. It might be a smarter process, like how Dell originally changed the game with its build-to-order model that just slashed inventory costs. Or it can come from just being massive, what we call economies of scale. Think of giants like Walmart and Costco. They buy in such insane volumes that they can demand lower prices from their suppliers. It's a powerful moat, but you have to be careful. You have to constantly defend it, because someone, somewhere, is always trying to do things cheaper. And finally, we have our 5th moat. This one's a little more niche, a little more specialized, but it can be just as powerful in the right situation. It's called efficient scale. This is basically a kind of natural monopoly. It really only applies to markets where the initial investment is so mind-bogglingly huge that it just doesn't make sense for a bunch of companies to compete. For instance, if a company has already spent billions building a network of pipelines, the market might only be big enough to support that one company. For a new competitor to come in and build a second one, well, the cost is just way too high for the potential reward. Okay, so now we know what moats are and the 5 ways companies build them. But how can we, as investors or even just as curious people, actually spot them out in the wild? Well, let's walk through a simple 4-step field guide to do just that. So here's the game plan. First, you've got to look for the financial evidence, the proof in the numbers. Second, you have to figure out why the company is so profitable. What's the source? Third, you need to take a guess at how long that advantage can actually last. And finally, you have to zoom out and look at the whole industry, the competitive landscape. Step 1 is critical. Before you even start telling a story about a company's amazing moat, you need to see hard proof that it actually exists. And that proof is always in the numbers. You're looking for companies that consistently, and I mean for 5-10 years straight, put up these kinds of superior numbers. These metrics are the telltale signs. They're the smoke that tells you there's the fire of a real economic moat. And this right here really gets to the heart of step 2. You have to ask why the company is so successful. You see, a moat that's built on having the newest, hottest technology is often pretty fragile because tech gets copied, and fast. But a moat built on a trusted brand, on what we call perceived differentiation, that can be incredibly durable. People pay a huge premium for a diamond ring from Tiffany that comes in that little blue box. And it's not just about the diamond itself. That brand power can last for generations. Now, this is a crucial point for step 3. You have to think about a moat in 2 dimensions, its depth and its width. A moat's depth is how much money the company is making right now. Its width is how long it can keep that up. So, a tech company with a smash hit product might have a very deep but very narrow moat, huge profits, but maybe just for a year or two. Then you have a company like WD-40. It has the opposite, a relatively shallow but incredibly wide moat. It's not a cash gusher, but it has been consistently profitable for a very, very long time. All right, let's bring it all home. If you're going to remember anything from all of this, let it be these key points, your own personal checklist for thinking about economic moats. So, let's recap the whole process. It starts with the numbers, but it always ends with the story. You see the evidence of high returns, and then you go digging for the why. Is it the brand, the network, the scale? And you never ever just ask how profitable it is today. You have to ask how durable that profitability is. Is this a flash flood of cash, or is it a river that's going to flow for decades? Answering that is the difference between finding a good company and a truly great one. So, I'll leave you with a question to chew on. Think about your favorite company, one that just seems completely invincible right now. Now that you have this framework, ask yourself, what's its moat? And maybe more importantly, could that moat be a little bit shallower or a little bit narrower than it looks? Because history has shown us again and again that even the greatest castles can eventually fall.